Over to you, Ritesh.
Thanks so much, Melvin. Hi, everyone. Good evening. We've received a lot of queries regarding all of our different portfolios and strategies, and now we have a full suite of offerings. So, of course, clients want to know a little bit more about how we construct our portfolios and how those investment strategies align to the long-term goals and needs of clients per se. So hopefully through this session, you get a better understanding of how we construct our portfolio, what's the investment strategy, what does your investment team look like, and how do we manage your portfolios on an ongoing basis and keep it optimized all the time. So please feel free to ask any in-depth questions that you might have throughout the session. There is a Q&A tab, so please post your questions there. We of course have Richard here with me, so he's the guru, so he will mostly take up all your technical questions there, right? But I'll try to give a more layman view of all of our investment strategies, and then as we dig deeper, Richard will come in and cover those as well. So let's get right into it. Let's see all of our portfolio offerings. A few things to mention in terms of how we think about investments and then how we think about constructing our different investment strategies. So the first thing that you will realize is Syfe is a very purpose-driven platform. We construct our portfolios to meet the different client objectives that might have. And to that effect, typically when you want to make your money work harder for you, there are three buckets that you want to cater to. The first bucket is your savings bucket, where you want to keep your money safe and liquid, and you want to maximize the amount of interest that you earn on it. So that's your savings bucket. The second bucket is kind of income bucket. So a lot of people who have, say, accumulated wealth and they want to keep the wealth preserved, but at the same time, they want to earn a steady cash flow from that corpus. That's where an income strategy comes into play very well. And to that effect, we have our Reits portfolio, which is known for giving good dividend yields. And the reason for that is because they, by law, are required to give 90% of their income as dividends to shareholders. So that's something that we'll cover in more detail later on as well. But ideally, I mean, someone looking for income, REIT becomes one of the asset classes that is highly sought after. REITs, of course, also has a growth element to it because they're listed on the stock exchange and their price also appreciates over time. But most of their returns tend to be dominated by dividends. So that's why people use it as an income strategy. The third bucket is the growth bucket, where essentially, once you have your savings bucket, income bucket, the third bucket is you have long-term, short-term, medium-term goals. And for each one of those goals, you would want your money to grow and you would want to beat inflation, because even in your savings bucket, you're generating, say, 1.75% if you're investing with our cash plus portfolio, but that's still below inflation, which is long-term around 2%. So if you really want to beat inflation and get capital appreciation over the long run, then you need to invest into a growth-oriented asset class. And that's where, typically equity market exposure comes into play. In our case, the way we think about it is, alongside growth, you also want to balance it with risk, your own risk appetite. And that is achieved by combining the equity with other asset classes such as bond and gold. So if you look at the, right-hand side, our core portfolios, global ARI portfolio and equity 100 portfolio, all of these basically cater to your growth bucket. And the way to understand this would be a core portfolio defensive is, dominated by bonds. So it's a conservative portfolio. Mainly people use it to preserve their capital, but at the same time get a return which is greater than inflation. So that's your defensive. Balanced is you want to, get a greater return than inflation and beat inflation on a consistent basis by a, reasonable amount. But at the same time, you don't want to, take too much risk. So there is a balance between equity, bond, and gold from that aspect. And then growth is predominantly equity focused portfolio. But again, rather than going all out to be 100% equity, it is 70% equity and 30-odd% bond and gold. So, again, that bond and gold element brings some stability into the overall investment profile. And then we do have our equity 100 portfolio, which basically is just an extension of the core portfolio, because essentially it is 100% equity portfolio. So this is something that people use as an alternative to stock market investing, where, if you want to remove your own human emotions and biases and you want to get a pure play exposure into the stock market, and you're, ready to ride through the volatility, then equity 100 could be a thing, could be a portfolio for you to consider. Now, while the core and equity 100 are the more portfolios which focus on long-term return maximization, there is also the specialized portfolio, which is our flagship product, which is called the Global ARI, that has a sole focus on risk management. And the main idea of that is to define a max loss kind of a threshold or a downside protection to make sure that you don't lose an amount greater than a certain threshold that you've put in. So these portfolios are for typical risk-averse investors, where if there are big drawdowns in the market and you want to limit the amount of sort of your own portfolio drawdown, then this is a portfolio which is a little bit more stable and helps you ride through these volatile times in a much more smoother manner, right? So we'll cover some of these aspects in more details in the next few slides. Let's first begin with the our core methodology, which then formed like the base for all of our other investment strategies and the way we think about risk and return. So our core investment strategy is called ARI. It is used for our global ARI and Reits with risk management portfolios. So just to get into the details of it, our core belief is that while returns are not predictable, they cannot be guaranteed from one year to the other. Risk is something that can be managed. So rather than focusing purely on returns, we have developed a strategy that takes into account what is the kind of risk that you're taking, and based on that risk, can you generate the most optimized amount of returns per se. So think about an example, right? Like, typically if someone tells you that I can generate you 8% returns versus another person comes and tells you I can generate you 12% return. Obviously, if you're just given those two choices, you will go for the 12% because you're getting better returns. But if I caveat those two statements by saying that, okay, you can get 8% return, but you can also potentially lose 15% on a temporary basis, versus you can also get 12% return, but now instead of losing 15% on a worst case scenario, you can lose 25%. So now, the answer might differ from people to people, because not everyone has the capacity to go through a 25% kind of a drawdown. So that's where we need to contextualize that, when you are talking about returns, don't talk about it on a standalone basis, because there is no free lunch. If you want to get greater returns, you need to take more risk. And that is what we have incorporated in our strategy. So coming back to risk management, what we realized was, if you look at the chart on the left, the dots over here, the X and Y axis is basically the spot week return and the forward week return. So the fact that the dots are just all over the place without any trend line tells you that there is no correlation between the current week return and the forward week return. So essentially, there is no predictability that if something has given you good returns in the past, will continue to give you good returns, going forward. Now, if you do that same analysis on risk rather than return, on the right-hand side, what you'll realize is that the spot week, risk versus the forward week risk, there is a good amount of correlation between, the past week, the risk element versus what is the risk that is possible in the coming week. So typically what happens is, if the market's been volatile in a given week, there is a high chance that the market might remain volatile in the coming week as well. And that's what I think brings a little bit more predictability and a systematic way for us to measure risk and use it to construct client portfolios. Now, why is it important to measure risk, and why is it important to manage this risk? Think about scenario where you have a certain drawdown. So for example, in 2020, the S&P 500, which is the US stock market index, dropped by 35%. Now, while a 35%, looks like, okay, it was a big drawdown, but think about the kind of recovery that you need if you have that kind of a drawdown. And that's what makes a lot of investors panicky. They sell in the worst possible time, and they actually end up realizing their losses. So if there is a way to contain your downside, that is what will help you, ride through these turmoils in a much, much smoother fashion. So this chart basically just depicts that if you're losing 30%, if you want to, if you're $100, your $100 becomes $70. If you want your $70 to go back to 100, you need 43% return. Similarly, last year, if the market went down by 35%, if you want to go back to even, you need 50% returns. So again, not that straightforward. People often overlook this whole aspect that there is a lot more to catch up, even though you lost, probably smaller number in terms of percentage. And why is it actually very important to manage this risk? Because actually these kind of drawdowns are fairly regular. We think that these, drawdowns only happen once in 10 years, once in 20 years. Like 2020, this happened where the equity market dropped by 35%. But if you just look at this chart, it tells you that S&P 500 has experienced 18 drawdowns of 20% of more since 1950. So and approximately every 3.5 years, you have a drawdown which is more than 20%. And again, as I mentioned earlier, most of the investors tend to be risk averse. So if you go through such turmoil, there is high likelihood that you try to time the market, try to get in and out. And typically what ends up happening is you get out at the worst time, but by the time you try to come back in, you've sort of missed the party. So I think that's where our methodology comes into play. And this is, again, as I said, for our global ARI portfolio, which solely focuses on risk management. This is, typically for a risk-averse investor who wants to limit their drawdown to a certain, quantified number per se. So when you think about traditional asset allocation, they will usually bucket your investment into, say, conservative, moderate, aggressive. And the way a moderate risk portfolio would be created is basically 60% to equity and 40% to bond. And the only rebalance that will happen is on a semi-annual basis or like on a periodic basis. If the asset allocation deviates from that 60-40, they'll just bring it back to 60-40. So there is nothing that addresses the risk element from the construction process. It is diversifying. So the diversification element is there to a certain extent. But because the risk is not diversified in the sense that even if you have a 60-40 portfolio, actually 90% of your drawdown is actually dominated by the equity portion. So even if you have only 60% equity, and that's what is depicted on the top hand side of the chart, where you see the the risk goes all over the place, even though you have a very seemingly diverse portfolio of 60-40. While in our case, when you thought about the global ARI portfolio, we thought about quantifying the risk and making sure that you can define a hard kind of a limit in terms of what is the maximum drawdown that you want for your portfolio. And we on a daily basis measure what is the risk of the portfolio going forward. And given the current asset allocation, what is the maximum drawdown that this portfolio can have on the next 1 year basis. And what we do is, if the portfolio's drawdown significantly exceeds the target risks that have been set for the portfolio, that's when a rebalance is triggered. So it's a risk-based rebalancing versus the traditional rebalancing, which is asset allocation based. And this is the reason why, the asset allocation is a bit more dynamic here. When the risk in the market goes up, we remove more risky assets and add more, safer assets to protect your downside. And that's why, you have a smoother ride through these turmoils. And then once the market recovers and the volatility comes off, we add back these, risky elements such that you also participate in the upside. So that's like typically how the global portfolio is constructed. And again, this is usually very, very good for a typical risk-averse investor. But we will also cover in the next section, the whole concept of our core portfolios, which actually goes very well for the more, normal investors like, who are professionals and who have regular savings plan and they just want to keep DCAing into their portfolio. So I think Richard will cover the next section in terms of how, this led to us considering another portfolio, which is a core allocation portfolio for most of the users, and how it differentiates with the global portfolio and what kind of clients use, a core portfolio versus what kind of clients should use our global portfolio as well. So let's actually, okay, before going into this, I think this is just showcasing our different investment portfolio options within Syfe, the global portfolio. So there are different risk levels from 5% to 25%. And this basically just tells you that the asset allocation is very dynamic. So while on a historical average, so for example, the moderate risk, which is a 15% downside risk portfolio, the average asset allocation is 60% equity and 40% bonds. But depending on whether the market is too risky or not so risky, the allocation actually changes to make sure that your downside is protected. So let's move on to the next section on the core portfolios, because I think that becomes very, very interesting for a lot of our investors who want a more passive way of investing and a way for them to sort of DCA into portfolios and also average out their cost when the markets are going down, right? So Richard, over to you.
Okay, thanks, Ritesh. I think just to give you a bit of background, a bit of color, as to why we came out with this core portfolio and what's the difference, in thinking between this and global RE. RE is automated risk managed investments, right? So in RE, what we did was we said, look, the thing that people are most concerned about is drawdown. Okay, so we focus singularly on drawdowns, and we try and keep your drawdown to the level that's promised 97.5% of the time. Okay, so it's basically focusing on risk. Okay, now some clients basically said, oh, we are prepared to take a little bit more drawdown risk, but when we rebound, we also want the returns, right? So the problem then is that because we are focusing on volatility, and as Ritesh showed in the earlier chart, when you have a volatile environment, the volatility just doesn't go away the next day, right? So the volatility lingers, and so as a result, with the RE product, although we keep it very safe, but when the market rebounds, we're very slow, relatively slow to catch the market rebound, okay? And then also because of the dynamic asset allocation, clients were saying, look, you're rebalancing too frequently, and we don't know, we don't see why we should have 100% equity, in 1 year, and 20% equity in another year, so in terms of the dynamic asset allocation, there was some concern, that if they want to do, let's say, something like dollar cost averaging, I think with Ritesh will talk about, later on, then it's very difficult to do because we're managing the risk for you, and you're basically using another kind of risk management technique, to sort of do regular savings plan or dollar cost average into the product. So what we did was we stepped back and we said, okay, let's start with the same framework, which is that we have a global market portfolio that we combine, in a Bayesian format, a Bayesian weighting with the risk parity portfolio. And I think if you want to know more about the details of that, we have a white paper, that we share on the website. But essentially, we start with the same, sort of model risk market portfolio that we use for RE. Now, from that point on, RE focuses primarily on risk. Whereas in core, what we say, okay, if you're prepared to be a bit more flexible on the downside risk, okay, we can actually then, instead of focusing on just singularly risk, we have a multifaceted focus, and we focus on maximizing risk-adjusted returns, okay? So the objective function is not to minimize risk, it is to maximize the risk-adjusted return, okay? Now, the other thing that we did was you say, okay, look, the RE basically has a relatively short-term risk horizon, which is roughly between 9 months to a year. For core, we think, okay, if you're longer-term investors and you're prepared to have a temporary drawdown, we can lengthen the risk horizon. So we lengthen the risk horizon to 10 years, okay? So which means that basically you can actually not have rebalance so frequently, okay? And just to keep things on an even keel, what we did, we said, look, the benchmarks rebalance twice a year. We will rebalance twice a year, okay? Unless there's something really, really, crazy happening, okay? So we target to rebalance, this core portfolios twice a year. We utilize a longer term risk horizon, right? And the whole idea there is to reduce so-called short-term portfolio reflexivity. And what that means is that we don't want to change asset allocation, too quickly, okay? Now, what's the difference between what we do and do we take risk into account? we instead of basically doing asset allocation, so for example, if 60-40 portfolio, when the asset allocations change, normally if you do it by asset allocation, you will basically say, okay, I will basically rebalance back to 60-40. We use something called risk budgeting, which is that we don't rebalance by dollar amount, we rebalance by risk amount. Okay, so essentially, if we use a long-term risk horizon, and then our let's say moderate portfolio has typically on average maybe 40% equities, 40 to 50% equities. But at the end of the day, we actually budget the risk of 40% equities into this particular portfolio, and so we don't target the whole portfolio risk. We basically let the risk go where it may, in a long-term basis, and then we actually within that risk we basically budget the risks of equities, the risk of bonds, and the risk of gold, okay, into this while maximizing the risk-adjusted returns, okay. And to add some more value from the equity point of view, so if you have the growth portfolio, for example, equities would be a significant part, maybe 70% of your portfolio. So we basically add this thing called smart beta into the equation, which we have actually done for our equity 100 portfolio, and we will talk about that after this particular section. Okay. Now, one of the things that we did also was we keep track of the different factors that are happening. Okay, so what we do then is say, okay, look, China, over this COVID period, has actually been the only, I guess, major country to have economic growth, last year, right? So, and when we looked at, we use our econometrics and graphical screens, we see that China, since the middle of last year towards the third quarter or so, starting to basically outperform the US, right? And so we thought from a strategic standpoint that we would include, more than a market cap weight, into our asset allocation for China and China technology, okay? Because, those seems to be like growth areas. Okay? So as a result of that, we basically put it all together and we came up with the core portfolios. And the core portfolios basically give you a kind of a one portfolio, one-stop shop, to basically decide, how much risk you want to take. And then basically we give you a portfolio that caters to this, maximizing the risk-adjusted returns while still managing risk, and then, on a long-term basis. Okay, so this is the whole idea behind core. So the next slide, yeah. Do you want to walk through the laundry list?
Sure, absolutely. So I'll just quickly summarize. So I think, again, just to reiterate what Richard was mentioning before, typically both the global and the core portfolios are a multi-asset class portfolio. They're composed of equity, bond, and gold. Both these portfolios are typically used by long-term investors who want to grow their wealth. And depending on your investment time horizon, your risk appetite, your financial goal, you choose different risk levels between these portfolios. Now, typically the global ARI portfolio is used by a more risk-averse investor who really wants to limit the downside and wants to make sure that they have a psychological know-how that my portfolio will not have a drawdown beyond this limit. So it gives them a sense of a more smoother ride. Versus the core portfolio has a relatively stable asset allocation. And what that ensures is that over time, if you are an investor who regularly contributes to your portfolio, you might experience some heavier drawdown compared to the global portfolio. But it gives you that chance that whenever there are drawdowns and if you put more money, you will end up buying more assets at lower prices. So in a way, dollar cost averaging. So typically, global portfolios used by risk-averse investors who maybe have a lump sum amount and they just want to, make it, run through an entire life cycle of investments without having too much volatility associated. Versus core investment is like, you do some lump sum, but if you also are doing DCA, this is probably a better strategy because the DCA can really be achieved because the asset allocation remains stable. Versus in global, if you do DCA, sometimes it ends up being counter to what you're trying to achieve, because in global, when the risk goes up, the equity gets reduced. So instead of, when you put more money, instead of buying more equity, it ends up buying more bonds during those times. So it, in a way, ends up doing double amount of risk management when you're trying to do DCA onto a global portfolio. So typically, I think majority of our investors fall under the more core category, where they want to, put in some lump sum, but they want to continue contributing to these portfolios on a regular basis. So again, the focuses are different. Global portfolio sole focus is on risk. Core portfolios, risk-adjusted return maximization. There are 11 different risk levels because you want to, manage your risk at a, very, minute, detailed manner. Versus in the core portfolio, there are 3 simple risk levels. So a defensive portfolio, balanced portfolio, growth portfolio. In terms of the risk time horizon, global ARI has a shorter term time horizon, and that's why if there are big fluctuations in the market, it results in asset allocation deviations for the global portfolio, and those could be fairly wide in terms of the asset recalibration and all. Versus in the core portfolio, because the risk term horizon is longer, the asset allocation remains more stable. Global ARI is diversified, but core is even more diversified with inclusion of China and China tech, which is basically also part of smart beta strategy that we have incorporated. So within the equity bucket of the core portfolio, there is smart beta element that has been incorporated. With the global portfolio doesn't have it in that format because again the sole focus remains to manage your risk per se. Now, just quickly looking at the core portfolios themselves. So as I said, there is a defensive portfolio, balanced portfolio, growth portfolio. Defensive, predominantly bonds, so around 70% bonds, 20% equity, 9% gold. Balanced, 48% bonds, 41% equity, 10% gold. And then growth is predominantly equity, and bond and gold then make up the rest. If you look at the returns, it just tells you the story, right? Like, if you look at the annualized return for each one of these portfolios in the pink, section, the core portfolio, of course, is lower risk and, also lower, lower return, but also lower risk. So if you look at the maximum drawdown of the core defensive portfolio, it's only 6%, versus, you go onto the other portfolios. So of course, your returns increase the more risk you're taking. So the annualized return for the balanced portfolio is 7.25% versus, we also compare the returns of these portfolios against the same risk, benchmarks, which is the S&P target risk benchmark. So this is not a benchmark that we have, created just to make our numbers look good. We, take a very serious note of, what are we comparing against? Is the risk sort of, equitable between what we are constructing and what, these benchmarks are? And again, if you look at the actual risk measurements, you see that the risks are not too different, right? So the standard deviation is roughly similar, but the Sharpe ratio is actually better for our portfolio because we get, higher return for almost the same amount of risk that you're taking. Of course, the drawdown risk increases a little bit to 7.7% here for the balanced. And then you have the growth portfolio, which has had a very good run over the last 8 years, because we had a full-fledged bull run until 2020. So it's given a much better return compared to the target risk portfolio. And again, if you look at it from a Sharpe ratio standpoint, and Sharpe ratio is basically for each unit of risk that you are taking, how much return are you generating? It is a much better return profile that you're getting with the core growth portfolio. And again, the drawdowns are higher. So as I said, there is no free lunch. You're taking more risk to sort of get more returns as well. So these are typically the globally diversified across asset class kind of portfolio that a lot of our investors use as foundational building blocks for their investments. And then when they have these foundational blocks built in, that's when they can go and take more risk or implement more strategies that are according to their preferences. So we'll talk about equity 100, which is a pure equity portfolio. So people who are looking at just full-fledged return maximization, they don't want any bond, any gold, they just want full-fledged equity, and they just want to ride the market up and down. Then we also have those options for you as an investor. So just quickly covering the core portfolio, what are the building blocks? So if you think about the equity portion, there is the global markets exposure. So, the US S&P 500, the developed markets and the emerging markets. So all of these are represented as for you to get a global exposure. And then we have these factors that help you get better return than traditional benchmarks. So these are again based on our econometrics and other data driven methodologies to understand what are the factors that are really driving returns to your equity portfolios, and how do we incorporate them to consistently generate excess return without really increasing the risk too much. So smart beta, China factor, if you look at the smart beta aspect, there is QQQ, which is basically your growth factor. But at the same time, we do have exposure to small cap, mid cap, and some of the sector-wise exposures, which are, if you look at the details, which sectors are here, it's typically the consumer staples, healthcare, utilities, which are supposed to be the more stable sector. So, they, in a way, implement more like a barbell strategy. On one side, you're taking, some extra risk, but at the other side, you are containing the overall risk of the portfolio by, having these evergreen sectors, which are supposed to be more stable and all. And then you have the typical, bond and gold exposure through the asset and ETFs, which are typically used for these portions per se. Now let's go on to the equity 100, because as I mentioned briefly in this section, the core portfolios and the global ARI portfolios are basically cross asset class portfolio, right? So they have equity, bond, and gold, and depending on your risk appetite and all, you can choose, defensive, balanced, growth, and all of those profiles. But if you're looking at only, say, the equity portion, then we also have that option for you, which is the equity 100 portfolio. And the smart beta, the reason it also mentions core here is because the smart beta element is embedded within the core portfolio in the equity portion of the core portfolio as well, right? So let's cover equity 100 in more details and talk more about the smart beta. Like, what does smart beta actually mean? Typically, when you're trying to invest into the equity market, you can just go and buy, say, S&P 500 or global market index, right? Like IWDA, if I'm not wrong, Richard, right? So you can get like a global exposure without really needing to do much, right? So that's your market cap oriented exposure to the broad level investment opportunity set per se. Now, while that gives you good returns and it will give you market returns, what has been observed is you can actually generate better return if you systematically capture certain risk elements that actually drive returns beyond the beta that you're getting from these market factors where you are investing on a global basis. And this is again different from active strategies. So typically what happens is there is two sides of the story. There is the passive strategy, which is just index investing, where you just keep investing into ETFs and then just leave it there. And then there is the active bucket, where there are active managers who try to outperform the indices by stock picking, and there is human element in that, where whether they get it right or not is hugely dependent on the ability of the fund manager and all. Now, we have realized that over the long term, all these active strategies, almost 90% of them underperform the benchmark. So rather than using these active strategies, what we try to do is we use rule-based strategies to really capture these risk factors that actually drive returns to your portfolio. And again, we'll cover this in more details in the subsequent slides. But what has been observed is, all these active managers who claimed previously that they have an ability to, pick the right stocks or the right, investment strategies to give you extra return. What actually happened and what actually, in research got proven was, this extra return is basically not independent of extra risk that these managers are taking. And if you can systematically capture these risk elements, then you can actually generate similar alpha, but in a more systematic and a rule-based manner. And that's what I think the smart beta tries to achieve, where instead of market cap weighting your investments, so if you're investing in, say, S&P 500, the largest market cap will be the highest weightage in your portfolio, and the smallest market cap will be the smallest weightage. So instead of just market cap weighting, we do the weighting based on these risk factors that really drive returns to the portfolio. And that's how the portfolio actually gives you a better, risk return paradigm and a mix, and gives you a better overall Sharpe ratio per se. So we'll cover more of this in the next section. The three main factors that we focus on is growth versus value, volatility, and large cap versus small cap. So these are the typical big factors that we consider. We've added a fourth factor, which is the geographical factor and emerging market exposure per se, which is the China tilt that we just talked about as well. But let's first talk about the foundational building blocks of how these factors came into play. So it's a little bit of a technical formula-based slide. So I'll let Richard take over and explain this.
Okay, thanks, Ritesh. Okay, I think obviously there are more factors than the more factors around and what we mean by a factor is just that you're taking systematic risk, because under modern portfolio theory, what it says is that if you take idiosyncratic risk, which means that the risk that the manager is good, the risk that the company is good, and so forth, that part is not compensated systematically. So because the idiosyncratic risk can be diversified away, okay? So the only thing that you get compensated for is the risk that is systematic and that cannot be diversified away, and that's what is called systematic risk premium, okay? So about 35 years ago, two University of Chicago professors, Farmer and French, Eugene Farmer and Ken French, came out with this three-factor model, okay? And this is an extension of what you call the capital asset pricing model. The capital asset pricing model, which won Harry Markowitz and some others the Nobel Prize, basically says, look, the market, every stock only depends on one thing, one factor, which is the market. If the market goes up, all stocks will go up, but the degree of it going up is captured by this thing called beta, okay? Now, what Farmer and French did was say, look, there's not only one beta, there are several betas. And in the first iteration, they came out with three betas. So you have beta 1, which is what the CAPM beta is, which is market risk premium, okay? Beta 2 is something called small size beta, okay? Small size risk premium, which is that they basically took the smallest stocks and they minus off the largest stocks. So you get this risk premium for being a small stock, right? Because being a small stock, you actually have more risk, and therefore you should be compensated more for owning small stocks, okay? And then the third thing is what they call value stocks, right? And high minus low is actually high book to price minus low book to price. And so when they actually developed this model, what they found was that this three-factor model explained more of the returns of a portfolio of stocks than the CAPM model, okay? So the R squared basically moved up, okay? So this is usually the starting point, for factor models. Now, it wasn't until much later that some very smart guy, coined this marketing term, smart beta, meaning that you have dumb beta and smart betas are the ones that you add the factors onto, right? So, but let's just walk through, how you would use this thing, okay? So now, if you look at the factor analysis, and you look at it over time, what Farmer and French did was they took a long-term history. So if you look at it over like 20, 30, 40 years, right, being small will actually give you risk premium, okay? That means you will be compensated by buying small stocks, but that's over the long term. If you buy value stocks, you also be compensated, but that's also on average over the long term. But in the short term, you notice what I've done is I've plotted the Farmer French factors over time, okay? And you can see sort of a kind of a sinusoidal, undulating time series, which actually shows that over time, the factors mean revert, to a certain level. But if you look at the orange line is the value line, okay? So since 2017, the value line has been going down. So if you had been investing in value over kind of a 4-year period, you would have been underperforming, okay? No doubt over a 20, 30-year period, this will bounce back up, right? But over this period, it's going down, okay? So what happens is that if you want to basically look at, really taking advantage of these factors, you can actually invest in value, but in value you'll be going down. Or if you think this trend is going to continue, then you invest in a counter of value, which is growth, okay, which is what we basically looked at. And so our portfolio, instead of using value as a factor, we use growth, okay? And the small size, you can look at the blue line, is also trending down, right? So instead of small cap, use large cap. So you can actually, bet on factors either way, okay? Now, having said that, the next slide shows that up to about October last year, the factors were all drifting down. But you notice from October, the orange line basically moved back up. So value basically started coming back. And the blue line, which is size, that means the small size premium, also started going back up, okay? So this is the time when you really need to rebalance, right? And for our factors, we rebalance twice a year. So in October, we were basically stuck in the growth phase, right? But since we're going to rebalance, in fact, very shortly, maybe first week or second week of April, right? We will basically look to, kind of slowly morph back into these factors. So instead of growth, we will basically morph into value. And instead of large cap, we will slowly morph into small caps to basically capture this mean reversion tendency, okay? Now, the next slide will show you how you actually would do something like this, okay? So when you look at factors, you can actually build factors yourself by basically look at stocks, and then you basically run a regression of each stock against the factors, and then you build a sort of factor portfolio which only loads on one factor, right? Now that's a very difficult thing to do, and because we don't use stocks per se, we use ETFs. So what we do is we actually look at ETFs that actually have factors embedded into it, okay? So for example, QQQ, we run a regression. So you can see here, we run a regression of QQQ against the Farmer French factors, okay? And so you can see from the regression that you have an intercept, the market minus risk-free rate, this is the market risk premium, small minus big, and high minus low, okay? So what this means is that the intercept is usually what the term is an alpha term. That means forget about the systematic factors. This is how much more or less you can make, okay? But although this has a measurement of roughly about 2%, right? Or actually this is actually 3 basis points, right? But the thing is, you look at the standard error, okay? The standard error is much larger than this. So what this, for those of you who are into statistics, what this means, a t-stat and p-value means that this number is statistically no different than 0, okay? And the factor loading, the betas, on the other hand, 1.12 means that QQQ actually has a larger beta than the market. It's 12% leverage, so to speak, okay? So you put a bet on QQQ, if the market goes up by 10%, you should go up by 11.2% kind of thing, right? So you can see the same thing for SPY. SPY is the S&P 500 ETF. You can see that the coefficient is roughly about 1, okay? So S&P is roughly the market. Now, when Farmer French build these models, they don't only use the 500 stocks. I think they use the 3,000 stocks in 3,000 or 6,000 stocks in the universe. They use the whole stock universe out of the Chicago research database, okay? And if you look at small minus big, so a negative number means that it's not small, it is big, right? Minus 0.26, that means it is actually a factor loading a beta of 0.268 negative, okay? You look at S&P, it's also negative, but you can see QQQ is higher negative. That means QQQ has, a preponderance of larger stocks. Now, conversely, if you look at RSP, RSP is nothing more than an ETF that just takes the whole 500 stocks of S&P. Instead of market cap weighting it, they say, look, let's just try something simple. We just equal weight everything. So out of 500 stocks, every stock will have 0.2% weighting, okay? And we build it like that, and we balance like that. And over time, you find that actually RSP does credibly, a credible job against S&P, which 85% of active managers don't, right? But just by reweighting the 500 stocks, you can actually do a decent job of beating the S&P 500, right? So if you look at this, in a sense, you can see that small minus big, the size, it is actually relatively small, and that makes sense, right? Because if you take the S&P 500 and you equal weight it, that means you are actually overweighting the smaller stocks, okay? So you see, compared to this, it's minus 0.168. This is plus 0.03. So this is basically, you know, a kind of a small stock bias, right? As opposed to a large cap bias, right? And if you look at the third thing, which is basically value. So minus, the QQQ has minus 0.419, which means that it is, you know, negative value, which is growth. You look at RSP, it is positive value, 0.176, right? And then you can see S&P basically has zero value, because obviously it kind of tries to mimic the market, so there's no value bias. Okay, so this is how we basically come out with the betas, and then with these betas, then we basically, you can see that this is what drives. So the orange line is QQQ, the blue line is S&P, and the gray line is the RSP. So you can see over this particular period, okay, up until October, you know, kind of a period. I guess you can't see this from this time frame, but the RSP basically started catching up, you know, from October, because value kicked in and size kicked in, right? The QQQ, because of the leverage factor, still went up, but you know, recently, you know, it sort of had a downdraft, right? So you can see actually it's the factors that basically drive the performance of these ETFs. Okay, so what we try and do is we try and basically map the factors, and then we say, okay, which factors do we think from our econometric and graphical screens would likely do well? Look at the mean reversion tendencies and so forth, and then we basically build a portfolio to reflect that. Okay, I think now another factor that we look at is the volatility factor. And what you find is that, there's some studies that show that low volatility actually is the minimum variance portfolio in an efficient frontier is the most accurate one. And that is a bet on low volatility, okay? So if you see, it's like a kind of a sinusoidal wave, right? There's mean reversion, so you can actually model it. And then the next slide shows that, what you find is that over time, if you basically have the lowest volatility portfolio, the minimum variance portfolio, you actually get more or less the same return as the market, but with about 2/3 of the volatility. That means you have a less risky way to get into the market. Okay, so what we've done in terms of the smart beta portfolio is, as Ritesh says, it's a kind of a barbell strategy, right? We go into QQQ, which is leveraged. It's a leverage bet on the market. It is a growth bet. It's a large cap bet. Then we build the low volatility as a barbell, so that overall the bet on the market is kind of market weighted, right? And we actually bet on some of the factors like the growth factor, and the low volatility factor, and that's how we sort of add risk premium to the returns. Okay, so that's basically. And then if you look at basically the performance, that we've back tested. Now, one of the things is that I should point out, and I think those of you who attend our seminars know this, right? When you talk about back testing, everybody sort of, kind of shakes their head, wrinkles their nose, and say, "Oh, back testing, sure, you know what's happening. So when you look backwards, of course, you will outperform, right?" But we do something called point-in-time back testing, which is basically no data snooping. That means we don't basically look back and say, hey, QQQs did well, and therefore we put more on QQQ, right? What we say is that, look, when we first start the testing, let's say in 2003, 2004, knowing what we know at that time, knowing the factor allocations at that time, how much we bet on QQQs versus RSP versus SPY and so forth, right? And we build it, and then we run it forward. The next rebalance, which is 6 months later, we will look at it again, and we rebalance and rebalance. So basically, it is kind of a back test, but it is a back test rolling forward, and we only use information at that point in time. That's what it's called, a point-in-time back test. It is one of the most robust back testing that you can do. Okay? So these returns really come from this point-in-time back testing that we do, and until we're confident that we can outperform in a point-in-time back testing, we basically, don't recommend that portfolio. So this is how we actually built this particular equity 100 portfolio. Okay.
Right. Thanks, Richard, for covering that in great detail. I think my voice is echoing. Is it all right? Okay. No, now it's better. All right. But thanks, Richard, for covering that. I think it was really in depth. Hope a lot of you got a good sense of how we are constructing these portfolios, and especially around the smart beta methodology. There have typically been a lot of questions. So hope this was informative enough for you to understand how we are using these smart beta techniques in a very, very systematic way and in a data-driven way to really drive these returns for your portfolios. So again, this particular chart just shows you, part of the portfolio is the global markets portfolio, but we also have these smart beta components, which, as I covered earlier, implements more like a barbell approach, where on one side you have technology and the high growth sectors, but on the other side you also have these utilities, consumer staples, materials, and all of these, these more stable sectors to overall bring the risk to a little bit parity, right? So, and that's the reason if you look at the returns versus risk, it is not the case that we are generating excessive return by adding too much risk. These risks are added on a more systematic basis. And because of that, on a risk-adjusted basis, you see that our Sharpe ratios numbers are much, much better compared to the broad level indices, whether it is S&P 500 or the more relevant benchmark, which is MSCI World, because our equity 100 is a global portfolio versus S&P 500 is just an US dominated portfolio per se. And again, these returns are more consistent over time. These are annualized returns. So of course, last year was really great. Our equity 100 portfolio was up 23% versus S&P, which was up 18% for the end of the last year. But even if you go back, 3-year, 10-year, 15-year, and again, annualized return year over year over year, you're generating double-digit return on a consistent basis with this. Now, again, one more important thing to highlight, and I think a lot of investors do have this question that, there are some US ETFs which have dividend withholding tax, and how do you optimize that to make sure that those dividend withholding tax are minimized per se. So again, we actually take a hard look at all the underlying universe of ETFs that we use, and alongside checking for the dividend withholding tax, we also see what is the management fee that the ETF manager is charging, what is the spreads that they are having, what is the liquidity that these ETFs have, and also what is the tracking error to the index that they are tracking, trying to mimic. So obviously one way of reducing the dividend withholding tax is to just go and buy the Irish version, so UCITS equivalent of these ETFs, which are basically listed on the London Stock Exchange, and they are Ireland domiciled. So instead of 20% withholding tax, you only pay 15% withholding tax. So what we have done is, for certain ETFs where it actually makes sense to use the Irish domiciled ETFs, we have already made those changes for you, so you don't need to worry about it. So an example is S&P 500, where we use the CSPX ETF, and we help you reduce your withholding tax from 30% to 15%. But then there are other ETFs where we go for the US listed ones, because even if you take into account the dividend withholding tax, you are actually much better off holding the US ETF, because the 30% withholding tax, you should not look at it in isolation. The management fee of the European or the Irish domiciled ETF for QQQ is actually having a higher management fee of 0.3%. And when you take that into account, and given that QQQ is a very growth-oriented index, the dividends are very, very small. So the effect on your portfolio in terms of the withholding tax is actually pretty minimal, and you will actually be much, much better off holding QQQ rather than EQQQ, because while you pay a higher dividend withholding tax, your actual management fee is much, much lower, and plus on top of that, you have lower spreads and higher liquidity in QQQ as well. So we do take all of these things into account, so you don't need to worry about it. This is valid for not just these two ETFs, for all the other ETFs that we use in our portfolio. We do take a very hard look into all of these metrics, and periodically we will review that if it makes sense to switch from one to the other. So all these things are optimized for you. All right, so I think let's stop here because it's closing in on 8 p.m. So let's take some questions, and then I'll just quickly wrap it up with how can people get started with our portfolios.
Great. So let's start with some questions. So I think a good one is actually from a participant called Hong Yao. So he mentioned that China stock ETFs has been under great pressure recently by China government and also the US government. So is Syfe's Equity 100 taking a big risk by increasing the China exposure during this juncture?
Right. Richard, do you want to take that, or do you want me to give some perspective first?
Yeah, okay. I guess we can both do this, but my opinion generally is that when you look at news and you look at narratives and so forth, yes, anytime you do you invest in stocks, that's part of the risk. Okay, you can say the Chinese government is looking at putting more regulations on, let's say, Chinese tech, right? But the fact is, Chinese tech is still going to be there. Alibaba is still going to be there. And financial is still going to be there. It's going to be restructured. Okay. So, but the growth aspects are still there. So the regulatory part is that, I mean, if let's say, for example, the Chinese government says, look, I'm going to close all of you guys down. This high tech is so dangerous and so forth. If that were the case, then I would relook at stuff. But newspapers basically and news media, they basically, I think, tend to, this is my opinion, is that they tend to try and, sensationalize a lot of things. And yes, of course, the Chinese government is basically looking at big tech and looking at, regulations and so forth. But think about it. I mean, after they put that in, you think the tech company is not going to respond? I mean, they're going to say, okay, we will change, right? I mean, today's newspaper says Tencent, the CEO has been called in to see the government officials, right? So, I mean, they will negotiate something, and then ultimately, the bottom line is that if China is going to grow, the tech sector is going to grow, the Chinese stocks are going to grow, right? So look at the underlying fundamentals, right? And I would say that that's the way I would look at it, rather than react. So basically, we don't really react to news narratives and stuff like that. We are cognizant of the risk, but we just look at it, we analyze it, and we say, okay, look, what's going to happen? Over time, this thing will be managed, right? It has been managed so far. I don't know, Ritesh, maybe you have a different opinion.
Yeah, no, actually, exactly the same thing. So, it's all about narratives. It's all about, the market tends to be a little bit, overreactive, and this especially been the case over the last, couple of years, where, certain news comes in, and then there is like, everyone piles in and tries to, sort of capture that information in some way or the other. So my view is like, China was the best thing, 6 months back. Everyone was like loving China, and suddenly, because of these rules and regulations related, news bites, people, again, it's like a little bit of a fear mongering. I think the long-term potential of China and emerging markets remain. There is no denying that. And in a way, I believe these regulations are actually good, because once these regulations are put in place, that actually brings more structure to these companies, and going forward they can operate in a much more diligent manner. So I think these are all great measures. These are good things to happen to the Chinese companies. And what that would mean is the long-term story of these companies evolving and stabilizing and growing on a consistent basis, that story I think remains. And the importance of China as an economy and the contribution of it to the overall world economy will continue to enhance and enhance and enhance. And if you're not participating in that, I think that's where I would be a little bit circumspect, right? Like, so don't look at short-term trends, is my opinion. Think of it as a more strategic long-term allocation. And then I think your concerns will be a little bit, subdued once you, overlook the short-term, sort of movements and volatility.
And the other thing I would add is this. I mean, one of the things that we always believe in is the portfolio effect, right? So of course you can focus, on the negatives, but hey, even in the growth portfolio, China is 14%, including tech and everything of the portfolio, right? So of course, if it goes to zero, you will feel the pain, right? But the fact is that just remember that there's a portfolio effect, happening there, and the 14% will give you some, upside, but there's some risk, obviously, right?
Okay, so thank you guys. That was a good conversation. So another one, maybe this one will be required for Richard to start as well. So why don't Syfe invest into other precious metals, right? Some things like silver, platinum, palladium, but only gold in your core portfolio. Any insights?
Okay, what we did when we first started out was we basically took, kind of a macro view, right? We said, okay, look, what portfolio, if you were to do a totally passive portfolio, what portfolio would be the most efficient, right? And so we look at global market portfolio, which is, the Markowitz at that time was 60-40 portfolio, right? And we said, okay, how did this perform over time, right? Is a balanced portfolio, Sharpe ratio is high and so forth. Then we said, look, what about postmodern portfolio theory? So Ray Dalio came up with this, thing, which is the risk parity type portfolio. And that over time seemed to be trending, outperforming the global market portfolio, but not all the time, okay? So when we actually merge these two using a dynamic Bayesian weighting kind of a scheme, we basically created, a model portfolio, so to speak, right? Now, in the model portfolio, we look at three things, okay, right? We look at asset classes. So if you generally buy equity, that's for growth. If you buy bonds, that's defensive, right? In case growth doesn't happen, insurance and so forth, that's bonds, right? And the third thing is inflation hedging. So inflation hedging, you can basically buy real estate, you can buy gold, you can buy palladium, you can buy oil, you can buy all these things, right? So the reason we stuck with gold was because commodities had been going through a down cycle, so we didn't get into commodities. Real estate is very, very local, right? So we thought, if we carve out real estate and say Singapore real estate, so we have another product, right? Other precious metals, would it add any value to inflation, hedging? I mean, it's correlated with gold anyway, right? So would there be any diversification by adding palladium and silver and so forth? So we didn't think from a macro perspective that would add a lot. So we never really, looked at, building other precious metals. And we thought gold was a good proxy, and everybody knows gold. And so that's why we chose gold, at that point. Okay? Now going forward, because this is the inflation hedging class, we may at some stage look at, adding commodities, because commodity seems to be at its trough and coming back, right? So this is something that we're also considering and looking going forward. But we're always looking at, at the, kind of new things that we can invest in, right?
Right.
But generally, the macro part of it, has to be sound, right?
Yep. And I think we do have some materials exposure in our portfolios as well, so
that's from the stock. That's from a stock perspective.
Yeah. So we do have some of those elements to, again, have a more indirect sort of exposure to these segments. But as Richard was saying, some of those might become more prominent going forward as well.
Great. So thanks for the answer, guys. So I believe if any clients have any preference towards those thematic materials, I think they can just write into us. We might have something for you. So do write into us, right? Let's not close the door there. So next question. Different platforms have different algorithms. So is there any research that has been done which makes Syfe choose smart beta over the other strategies? And is the research publicly available in any form like the white paper?
Okay, we didn't write a white paper because we don't need to. There's so many papers out there. As I said, Farmer French, the three-factor model was written, nearly 40 years ago. Okay, so if you Google Farmer French, you can get their original paper. The term smart beta was, I think, coined by a gentleman called Edward Qian, Qian. Okay, and I think he's the CEO, CIO of Panagora. I'm not sure, but I think it's Panagora. So if you basically, Google smart beta, you get a link, to Edward Chen's paper as well. So there's a lot of stuff written out there about smart beta. For example, there's a company called Dimensional Fund Advisors that basically has been running, they don't call it smart beta, I don't think, but they've been running essentially, the Farmer French factor model, for the last 35 years, So there's a lot of smart beta, there's a lot of material out there. I think all you need to do is Google it.
Yeah, so actually, smart beta is the technique that is very easily searchable, available, and there are very easy read articles available, so you can definitely go and check them out. One reason why we went for these strategies is because we don't want to actively predict the market and don't want to take positions that we believe this will this sector will do this, or this particular asset class will behave in a certain manner. We wanted to implement strategies which, again, if you go back and understand smart beta, it tries to capture risk premia in a systematic manner. So that systematic manner is very important to us, because the core of our strategies is to not have human emotions and biases to change allocations which tend to underperform over a long-term period. So rather than having active strategies, smart beta and related strategies are the more better ways to get a little bit more juice for your money and grow your money in a more risk adjusted return maximization standpoint.
Great. So I believe this will be the last question for this evening, right? So Miss Wei Leong, actually, so sorry if I'm pronouncing your name wrongly. So he or she is actually interested in the full Reits portfolio. So her concerns are, despite all the hype about post-COVID recovery riding on the vaccination push, right, Reits has actually delivered rather poor performance this year thus far. So with increasing geopolitical tensions between the major powers and the rising 10-year US Treasury yields, does Syfe see any potential downside risk for the Reits portfolio in the near term? Or do Syfe see the Reits to trade sideways, right? Is there a forecasted dividend yield for Reits? So I believe this is more of a outlook kind of question. So we do have those outlook webinars actually, which is held once every quarter. But I think for the sake of this plan, maybe this is one thing that Ritesh might want to take.
No, sure, absolutely. So I think you're spot on in terms of what's happened to the Reits market, and Reits market have been a little bit sensitive to the interest rate movements. Typically, what happens is when the interest rates are moving up with a view that the global growth is going up, it is actually positive for the Reits market. Right now, what has happened is the interest rates have gone up in a very dynamic, crazy manner, and which was the concerns of rising inflation. And again, this inflation is something that was way beyond what people were initially expecting. So when those kind of things happen, it tends to spook the markets a little bit, and that's what happened to the Reits market, that it trended down quite a bit over the January and February months. But if you look at the Reits market just over the course of the last 2 weeks, it's been recovering quite well, and the concerns of inflation has pared down quite a bit. And again, hopefully, if the vaccination programs and the economic recovery story continues to play ahead, our belief is that Reits could be one of the asset classes which can have more. Again, if you go back to value, if you go back to the fact that in fact Reits should be your inflation hedge. And in fact, if economies and all open up, the revenue drivers for these businesses could be much more pronounced. And these are the more beaten down segments of the market, right? So they should actually really have that upside coming in. So in general, I have a more positive outlook on Reits. Say if you're having a horizon of 3 to 5 years, I would tend to overlook the short-term, fluctuations that you're observing in the market. And generally speaking, I mean, there is a particular purpose behind investing into Reits. I, for example, use Reits as a way for me to diversify outside of my global markets exposure, hedge currency risk, and also from a long-term standpoint, have that element of passive income, to be slowly built up. So I think of Reits as that allocation that I'm slowly growing over time, and I want to maximize my dividends and returns from it And maybe right now I don't need the income, but 10 years down the line, if I want to have an income strategy, I can just keep drawing out the dividends from this portfolio. So again, think of REITs, more from what are you trying to achieve from it. And if that is taken care of, then I would tend to ignore the short-term volatility and all the things.
Great. So thanks. Richard, do you have anything to add? If not, that will actually be the last question for this evening. Oh, Richard, right. I believe you're on mute. No question. Nothing else? British, anything to add?
No, let's just cover quickly, if there are, folks here who have not yet signed up on our platform, it's really, really easy. You can go onto our website. Our app is available on the Google Play Store as well as, Apple App Store. There is a Get Started button. You click on it. It will ask you a few questions. You answer. You will get a forecast. You can see past returns. You can see, what different portfolios, are in terms of composition and all. And then if you like it, you can just subscribe and open an account. Once you actually create your account, everything is transparently shown. So whether it is the current value, your profit or loss, your transactions, the composition, even the fees are shown on a very, very transparent basis. So again, in terms of the platform itself, it's a very, very simple, straightforward platform. We don't believe in having, too many gimmicks attached to your investments. What that means is there is no transaction fee, there is no entry charge, there is no exit charge. There is no minimum amount to start with. So you can really experiment and start with like small amounts if you're not sure where to get started. There is, no charges on withdrawing. So anytime you can come in and you can go out. Hopefully, as I said earlier, you use our portfolios for your long-term goals. So there is usually no need for you to withdraw until you really need the money. But we, believe that, there is no point charging clients to take their money back. It's your money after all. So we should not be charging for that. There is, unlimited rebalancing. All of those are done free of cost. You can actually switch between the different portfolios. That's also, free. So you don't pay for it. Dividends are automatically reinvested. So again, if you compare that with DIY strategies, it's actually, pretty powerful in terms of what you're getting versus what you're paying for it. And if you look at our overall fees, the more you invest, the better. So the management fee progressively comes down. So if you're investing less than 20,000, then it is 0.65% per year. 20,000 to 100,000, it's 0.5%. 100,000 and above, it is 0.4%. And plus on top of that, if you have more, more in-depth requirements in terms of really, trying to make sense of our portfolios and trying to understand how do you align these portfolios to your goals, you have access to, our wealth advisory team. So, feel free to talk to our wealth experts. On our website, there is an advisory tab. So, just click on it and schedule a call, free consultation call with us. Now, I think I just wanted to highlight this one more time that, if you compare the Syfe strategy with a DIY strategy, you get a lot more for what you are, able to achieve. And the best thing is, it's sort of hands-free for you, right? Like we do all the heavy lifting in terms of managing the portfolio, keeping it optimized, reinvesting your dividends, taking care of your brokerage costs, you can switch between portfolios. All of that is taken care of. All you pay is basically the management fee, depending on what tier you are. And then there is no other hidden fees and charges for each transaction, and all those, kind of gimmicks are removed away. So again, I'll leave this part here as well. We have a full-fledged advisory team, so feel free to engage with our wealth experts. And yes, for all the joiners today, thank you for spending time with us today evening. There is a small promo that we are offering for all of you. So just please complete this feedback form. Once you complete it, you will be eligible to get this 6-month fee for the first $30,000 that you're investing with us. So I will leave this for a few more minutes, and then we will wrap it up. Any other comments from you, Richard, before we wrap it up?
No, actually, I just wanted to clarify. You went through the fees so quickly, but the point is that it is not a tiered structure. It is basically if you invest 100,000 across all the funds, it is 40 basis points across everything. It's not like the first 20,000, the first that kind of thing.
Correct. Yes. So it applies for the whole amount of investment. And also, I think I forgot to mention the cash portfolio that we have. It's one of the highest yielding, projected return portfolios, across different platforms. So, do take a look at that as well. And in that portfolio, actually, we don't charge you any management fees. So, I think it's a great value proposition for especially people, given the low interest rate environment and the bank interest rates being, the savings accounts interest rates being so low. So you're taking a little bit of a risk, but the actual return that you're getting through this is way higher. So and the money that you're investing through the cash plus portfolio goes into money market and short duration bond funds. So again, very low risk, but you make your money work much harder for your investment savings as well. All right, so I'll leave it here. If there are no more questions, thank you everyone for joining in today. If there were any questions that we could not handle, do reach out to us through the feedback form, or set up a call with our wealth expert team. Thank you everyone.
Thank you guys.
Okay.
Have a great day.
Bye.
Bye.
Bye.